The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host, the president and the owner of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Good afternoon. I know our listeners don't know, but I'm going to share with them. Wednesday was Victor and Rainey's anniversary.
Oh, my gosh.
How many years?
Too many. No, I'm not.
Whoa.
Enough.
Cut that out. Cut that out.
Honestly, it's like I said, it seems like yesterday.
Yeah.
It's weird, because I have a past.
Right.
And it's weird when you find the one. It makes everything different.
Oh, that's good. I know Rainey was pushing to go to Hawaii or somewhere nice.
Oh, yeah.
Did you decide that was the plan?
For those of you who don't know me out there, I'm kind of a workaholic type.
Absolutely.
Got
that from his dad.
That's right.
It's true.
My dad always said, "What are you sitting around at home for? Go to work."
Yeah. Nothing going on at home.
That's right. Go to work. So that's always been my thing. So my wife always bugs me about getting out of town and stuff like that.
Taking trips.
Every once in a while, I'll take a long weekend. I'll take a week once a year.
Well, you got the kids back in school in, 2 weeks, you said?
Oh, yeah, they're almost there.
So if you're going to do it.
No, I know. It's not happening.
All right.
Way too much work to do.
Too much work. All right.
Remember, we developed this show to answer your financial questions. So many financial shows we hear out there are basically just an infomercial on their next seminar or selling some annuity or some managed product or some investment trading strategy. We really try to teach you stuff. Obviously, we do this show just like everyone does their shows to get business. But even if we don't do business with us, I promise you one thing, that you'll learn something in almost every show.
Yeah, and we have a lot of phone calls, a lot of listeners that, for whatever reason, it's not appropriate for what we're doing. And we help them all the time. Pro bono comes to mind, and get them set up at low fee discount houses so that they can at least facilitate what they're trying to do and get them postured maybe down the road where we can help.
E-Trade and Vanguard should cut us some checks.
Absolutely.
Because we recommend them so often.
That's right.
That's what people always ask me. Why would you recommend? I go, well, if you're okay with the risk of the market and you've got the educational background and the wherewithal to invest, there's nothing wrong with investing in yourself. There's just so many other things that come up that you might not be aware could come up,
And a lot of times as we're working with someone, we'll find out they already have, let's say, a Vanguard account, and we can help them adjust it, rebalance it, do some things that might be a little bit more helpful. If they've got several mutual funds that may be overlapping each other. Also, they may have current 401ks that they can't move because they're not 59 and a half. They haven't separated service from their companies. And we work with them all the time to help them and at least give them some guidance. So if you're listening, if you've got questions on your 401k and you're not quite ready to retire, or you're getting ready to, give us a call. We're more than happy to kind of go through that a little bit for you, at least give you some advice and an opinion.
Yeah. Our number's 972-715-2424. Again, 972-715-2424. All right. First off, we're going to go over your questions because that's why I do a little bit of the show. But first, I wanted to go over 10 reasons why just about everyone needs a written retirement plan. Trust me, most advisors don't do this. They'll come up with something, about, I'd say half of them come up with something. The other half just basically give you advice where really not know anything about you. They'll just take your age, and that's all they need to know. You're a certain age, and we think this is a good plan for you.
And they give you advice based on what they do.
That's right. Or they do have a managed program, and every single person in every single situation always fits into that program.
It's true.
Which is craziness.
Yeah.
But that's, that's what they do. So our managed program is for anybody. If you're 30, if you're 50, pre-retiree, retiree, if you need income, you don't need income, if you want to pass money to heirs or you don't, this is a one-size-fits-all in every situation.
Get out of your 401k. It's not your money anyway.
Oh.
Quit your job.
Anybody ever tells you that, just remember, we've talked about this before. Anybody tells you not to invest in your 401k, I don't care if you have bad choices and your company doesn't match crap and all that. They're not looking out for you. They're looking out for themselves. Because you should always contribute to a 401k or 401a or 457 plan, thrift savings plans, whatever they might be in your particular situation, because it is almost impossible to accumulate assets faster because of the tax deductibility nature and the tax deferred nature of those accounts.
Yeah, and if you're fortunate enough to have just one or two employees and you're self-employed, SEPs are outstanding. You can really
SEP
add a
is
lot
a
of money.
simplified employee pension IRA, which allows you to put like 25% of your income up to $50-something thousand
Per year.
per year, right off. In other words, if you made 200 grand, IRS is going to see you making 150.
Now, we talk about that. So the downfall of that is if you give yourself 25% of your
right.
income up to the limit, you have to give every one of your employees 25% of their income. So if your wife's your employee, good thing. If you've got 4 or 5
No, don't do
other employees, it's probably not so good.
There are plenty of other plans to do that with. And if you, like I said, if you have any questions about your particular situation, you're small business owner, self-employed, don't hesitate to call us at 972-715-2424. All right, I'm going to go with the 10 reasons why everyone, now I'm going to couch everyone. Everyone over 50, number one. Everybody over 50 needs a written retirement plan, unless you're planning on retiring at 90. If you have, because what happens is, even if somebody like myself, I don't plan on retiring. I'm in my 50s, and at 70, I know I'll take Social Security just because it won't go up anymore. But that's the only thing I have to retirement.
Not only are you not going to retire at 50, now I plan on slowing down at 65 and working less. You're not going to slow down at 65. You're going to still be working 60 hours a week, I promise.
There's nothing else. So if you're over 50, okay, you need a written retirement plan, not somebody's assurance or a Monte Carlo simulation, which I see all the time. Here's a Monte Carlo simulation that shows you in the
2,000 different things that can happen with your money.
12th percentile that you will be very rich your entire life. Okay, that means nothing.
I've noticed it. I went through this list briefly before we started, Victor, and obviously there's some good ones that are always in the top 10, but there's a lot of new ones for the situations that we're in right now.
Sure.
Good stuff.
If you're under 50 and contemplating an early retirement, okay, then a written retirement plan could really benefit you as well. And remember, we do these at no cost or obligation to you. But here's number one. The number one reason why everyone needs a written retirement plan, their lifespans are increasing. You'd be surprised. They did a study recently where they said, okay, the person that lived the oldest in your family is how much? And they said, I don't know, 95. And they said, what do you plan on living to? 80.
Right.
Nobody ever plans, but a man's life expectancy has gone up like 30% in the last 30 years. So what's it going to be? I'm in my 50s now. What's it going to be when I'm 85, right? It could be 100, 110.
Think about the inflation. You're in your 50s, that's 35 years worth of inflation.
Oh, absolutely. Since lifespans are increasing, like all these retirement plans I've seen, these prepackaged ones, will show basically a standard 20-year retirement. Almost every one of them does. In 20 years, as long as you make 6% a year, oh my gosh, you're fine. But what if it doesn't make 6% a year? Like the market for the last 15 years, you want to look it up, has made 4.24% with dividends. The actual capital appreciation of the S&P 500 is only about 2%.
So let's look at that. If you retired 15 years ago, what did you average?
That's right, 4% a year.
4%.
That's if you equaled the S&P 500, by the way, which 80 to 90% of people do not average the S&P 500. So
when you take out fees and everything, that's
I've seen reports the last 15 years, the average person really made 2. But what happens is you get skewed with recent memory. And what you'll say is, oh, it's gone up like crazy since, well, I know it went down in 08. We suffered through that, but since then it's done crazy. And you're right. But if you take all those big down years in 2000 to 2002 and 2008, count them all together, you've really made 4% a year if you're the top 10% of investors.
Again, think about that. Let's say 4% was the average. Victor said that they're really only making 2 after fees and all the expenses. So you retired at 70 15 years ago. You're now 85 years old. You've gotten 2% for 15% for 15 years. Depending on what you withdrew, do you have any money left?
And your expenses are a lot higher. I'm telling you right now, I'm paying the same. This shocks me to this day. I think I'm getting screwed in Prosper right now. I'm telling you, it's ridiculous.
What's the rate?
I'm paying $400 or $500 for a water bill.
Oh, yeah.
It's the same as my electric bill, which is also ridiculous. And who'd have thought that 20 years ago that your water bill would rival your electric bill?
Didn't you tell me, because I know your sister lived in Fairview for a while, that their 1 acre lots, and the water bills were like over $1,000
They
a
had
month.
2 acres, looked like an arboretum.
Oh, it's expensive.
Yeah, I'll gouge my eyes out and put gravel over that whole yard before I spend $2,000 a month on
That's
water.
a lot of money.
All right, that was number one. Lifespans are increasing. This is a big deal. We're going over why everybody needs a written retirement plan. The next one is historically low interest rates. You know, the old days we thought, I'm going to save $1 million. I'm going to live off that 8% CD or 10% CD, and I'm going to be fine. Well, CDs are paying 1% now. 10-year bonds are paying 2.5 maybe. You got to go into a high yield category to get 4 or 5. And if interest rates go up, trust me, folks, high yield bonds are going to get destroyed. And so, what else do you do? How can you maximize your income during retirement in this kind of environment? And also remember, it's not going to get better because if they go raise interest rates, it kills our national debt. It's ridiculous.
They're
It adds like
controlling
$500 billion a year in interest
right.
rates. Oh, we got a break coming up, folks. Stay with us. Remember, if you have any questions, 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, today we're going over the 10 reasons why everyone needs a written retirement plan. This is not a Monte Carlo simulation about a mutual fund or a managed program. It's much more detailed than that. They go into, your effects of Social Security, cost of living adjustments on Social Security, medical expenses. Is there a possibility you run out of money? Stress testing your portfolio, maximizing Social Security. There's all kinds of different issues that go into this. But the first thing we said, 10 reasons why everyone needs one, is lifespans are increasing. In other words, you're going to need more money than ever before, ever in history, because we have a combination of low interest rates and longevity is increasing.
And think about
worst combination for retirement.
Just a statement, lifespans are increasing. It's not saying lifespans have increased. It's increasing. It's ongoing. 10 more years, we're going to even live longer than we're living today.
That's right.
It perpetuates.
So those are the first two, lifespans increasing, historically low interest rates. Number 3 reason, most individuals are misinformed about the amount of money they'll need in retirement. I get this all the time, especially young people considering early retirement. I'll find a young couple, 40, 45, they've saved $800 to $1 million, which is very commendable, by the way.
Absolutely.
It's absolutely fantastic. But they think they're going to retire, and they need $10,000 a month.
How many plans have we done with $1 million, $1.5 million?
Oh, yeah.
But because of expenses, it doesn't work.
Because remember, they can't start their Social Security. They're going to retire at 55, right? That's not for at least 7 years. But if they need $10,000 a month, it takes a whole lot. Remember the 4% rule that was around forever says for every $1 million, you can take out 4% or $40,000 a year. You can increase that with inflation. That gives you a 90% chance of not running out of money. That rule was redone at the end of 2013, and it comes out that 2.8% is the only safe withdrawal rule to still give you a 90% chance.
And that ain't much,
no.
to use bad English.
To think of the inverse of that, okay? The inverse of taking out 4% is multiplying your annual need by 25. The inverse of taking out 2.8% will be approximately 35. So there's a quick exercise you can find out, all right, how much money am I going to need at retirement?
Great tip.
If you need $10,000 a month, that's $120,000 a year, multiply it by 35. It's about what, $4 million, something like that?
Yep.
And everybody thinks, no, $1.5 million would be fine, $2 million would be fine. No, it's going to take a lot more than that.
It's kind of a double negative. Expenses are increasing due to inflation and all of that, and interest rates are low. And then you've got on top more than a double negative, and then you're living longer. So you got to take it all into consideration.
That's why it's so important. Written retirement plans are more important now than ever before. And that's why we offer them no charge, no obligation for anybody out there.
And as always, we always like to say we're not trying to scare you or be negative. Right. It's just if you're aware and if you're prepared, you prepare for the worst, you expect the best, it'll be fine. If you sit down with a plan, what income you're going to need, what income you're getting, what assets you have, it's easy to come up with a solution. But when you don't know, it seems scary.
Oh, and also, like I said, you got to figure out what inflation will do. Just like I told you earlier about my water bill now rivals my electric bill.
Yep.
That kind of stuff won't stop. And so everybody always does this simple math. All right, I need $5,000 a month. That'll last me 20-something, 30 years. That's if you have zero inflation for the rest of your life. Which
Or
is not gonna
emergencies.
happen.
Or emergencies.
That's right. That accounts for nothing. No contingencies. It won't work. You can't do it that way. All right. Another number 4. Most individuals are misinformed on how much risk they're actually taking. Everybody says, well, I'm a 50-50 portfolio, so half my money's at risk, half my money's safe. And in the old days, that was true. Now it's not. I'll give you an example. Let's say you have a 50-50 portfolio, 50% fixed income, which is typically bonds or bond funds, and 50% equities or stock or mutual funds, right? Well, normally they hedge each other. They don't when the interest rates are zero, because what happens is interest rates go up, bonds go down. And so now we've got a double anchor. We've got a market topping, and at the same time, interest rates are at the historic lows. So that is a recipe for having dual risk. So a hedge is not working. A more effective hedge for your fixed income piece would be CDs, money market. I know they're not paying anything, or a 1-year bonds, fixed annuities, fixed index annuities. The reason I'm saying those, because it doesn't have interest rate risk. And so that's a more effective hedge to your stock portfolio.
One of the problems with these low interest rates right now, too, for your safety, it causes you to start seeking yield and stepping out a little bit. And I've seen a lot of times, Victor, you have too, when someone comes in with their portfolio, they're aggressive, their inflation hedge, and then their safe stuff. A lot of times in that safe pile are things that aren't that safe.
No, not safe at all. But okay, number 5. These are the reasons why everyone needs a retirement plan. If you're over 50, absolutely. If you're under 50 and contemplating an early retirement, you also need one. All right, number 5. Most people are uninformed on how many fees they're paying or how the fees are paying and the impact of those fees on their retirement well-being. I hear this all the time. I don't pay anything, I hear.
No, I know.
Yes, somebody.
They really believe it.
Absolutely. I don't pay anything. I only pay this amount when I can prove they're paying this other amount.
And if you don't know, call us, 972-715-2424. Again, 972-715-2424. It's easy for us to identify the fees for you.
Because I don't mind paying fees for service. I don't mind going to the movies. I'm getting a benefit from it. I don't mind paying fees. I just don't want to make sure I'm not paying the high fees for the same or worse service. And that's what happens. I'd say most of the time people come to me and go, I haven't talked to the broker in 10 years. They don't do anything for me. This thing, I just talked to someone this week. I have made 0.6% for 10 years, and I'm paying these fees. What for? Well, those are the kind of answers you get with the retirement plan. Also, we got a break coming up, folks. Stay with us. Remember, if you have any financial questions, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're going over the top 10 reasons everyone needs a written retirement plan. We've talked about lifespans are increasing, historically low interest rates. Most people are misinformed about the amount of money they'll need for retirement. Most individuals don't understand really how much risk they're taking. They also don't understand the fees they're paying. Well, number 6, go ahead.
I was just going to add to that. And one of the reasons you don't understand the fees that you're paying sometimes, or how well your account's doing, you think it's doing better. A lot of times they're 401k accounts or retirement accounts, and you're adding money in all the time. So you see the balance going up when it may not be doing that well.
Number 6, most people don't have a good understanding of the difference between the accumulation and distribution phase of your financial life. There is a huge difference here. Like I said, I have a lot of engineers and doctors as clients because I'm that type. You know, it's got to be proven 500 ways, and you better give me every reason not to, and you better answer them perfectly.
And the inverse relationship is what?
Right. So most people don't have understanding really, because what they'll do is, let's say they've been successful at investing. They'll do the exact same thing throughout their retirement that they did during the accumulation phase. When during the accumulation phase, it's a totally different world.
You're not withdrawing money.
You're not withdrawing money. If you ever do a chart or do an analysis where you're withdrawing money and you take one of those big down years, like a 50% down year that's happened twice in the last 15 years, it is a death spiral you can't get out of.
It skews the numbers down.
It's impossible. You have to change the way you invest when you approach retirement and you're in retirement. It'll be completely different. Don't get me wrong. Will you still have some equity? Sure. Will you still have some growth stocks, some dividend stocks? Absolutely. But it's different. And you have to account for any and all down markets because they can wreck your retirement if you're taking out significant withdrawals during a bear market. If you would like to see the math on it, I'll be more than happy to show you. And it's 972-715-2424. You can go to our website at ilovemyretirement.com.
The only exception I could see to that is if you've saved north of $5 million and your expenses are low, you only need 50 or 60,000, then you're not going to have an issue.
That's right.
In the distribution phase. But
unfortunately, most of us don't fall in that category.
That's right.
Like I said, it depends on. Remember, it's 35 times what you need annually is to give you that 2.8% withdrawal rate.
And never run out of money.
Never run out of money. All right. Number 7. Most people haven't accurately accounted for the financial ramifications of one spouse passing away or becoming incapacitated. This is a big one because most people, like I said, they'll say, well, all right, they might have gone as far as say, well, okay, we'll lose, if one passes away, we're going to lose the lower Social Security. But also you got to say, all right, what if the one that passes away is the one that really does the finances all the time? Is the other spouse going to be okay? You kind of know those kind of things.
Now, mine's going to come to you. That's okay, right?
That's right. That's all right.
All right.
But also is what happens if one becomes incapacitated, which is more likely as you get older. Well, the bills don't change much at the household, do they? Except now you got a $70,000 a year, nursing home payment coming out. And so you got to look at you got to address those situations in your life. What if something happens and you can't just do they'll usually, well, what if the man dies? Well, the man might not be the one that does the finances. The man might not be the one that has the higher Social Security or whatever. It can go either way. You really need to look at the ramifications of each spouse individually. And what happens to your financial picture if that does happen?
I was real impressed a couple of years ago. I had a guy come in that said he had Alzheimer's in the family, and he wanted to take care, and we set up some income for his wife, but he wanted to make sure his wife had income in case and when it would occur to him. And I thought that was
and that's
very
my,
sharp.
I don't want a $100 million life insurance policy that puts a bounty on my head.
Right.
But taking care of my wife, make sure she gets income, the family's taken care of, that's my main purpose. I want income till I die. And I want the spouse to have income till she dies. Other than that, like I said, leaving money to my kids, they're welcome to every dime I don't spend. If I have to spend it, just be lucky I'm not a burden on you.
But you know what? Having that income having the money take care of the income leaves more, usually, for the kids.
All right, number 8. These are the top 10 reasons why everyone needs a written retirement plan. If you're over 50, you got to have one. Under 50, if you're contemplating retirement early. All right, number 8. Most people don't fully understand how much they'll need to cover medical expenses during retirement. I've seen all these studies ranging from $200,000 to $300,000 per person, and you'll have a couple that's save $400,000, and they don't understand. There's no way medical costs can cut. I tell you what, my mother-in-law is on Medicare. She uses my address. You know how many of these bills come in?
Right.
Because there's still copays and all that stuff, and she doesn't have the means for that kind of stuff. And so there's a lot of bills. Number 9, most people don't effectively analyze their pre-retirement assets to ensure that they're ready for retirement. Remember, they'll do that simple math calculation. All right, I need $2,000 a month. This will do this. If it doesn't make anything, I got 20 years there. And that is one way to do it. At least that's giving you some kind of check. But there's so many other things. You got to factor in inflation, medical expenses, longevity. All of these different issues have to be factored in. And that's what a written retirement plan does. Remember, call us if you'd like to take advantage of it, 972-715-2424, or go to ilovemyretirement.com. Well, we got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're talking about the 10 reasons everyone needs a retirement plan. Everybody over 50, 50 and over, or anybody under 50 if you're contemplating an early retirement. I am really, really passionate about this kind of thing because so many so-called advisors out there are just some salesmen of some program, some trading program. They're just selling an annuity. They're just selling this. They don't care if you go broke during retirement.
They'll talk you out of something good
Oh,
to
absolutely.
do something else.
Remember the one we talked about last week? They're telling everybody, cash out all your 401ks to buy my rental property program. Cash out everyone. I don't care if you pay 50% taxes. It's worth it because we're going to double your money. Those people don't care if you go broke and you're eating cat food at 80. I do. And we are very passionate about if you have a written retirement plan, it helps you illustrate exactly what your life is going to look like at 60, 70, 80, and even 90 and beyond. And that's what everyone needs, because if they don't get that, you could fall victim to these crooks out there, and it just upsets me to no end that they're so prevalent. They're everywhere. They're on the television. They're on this radio show, everywhere. And anybody gives advice like that, it just kills me. I'm sorry, I didn't mean to go off there.
No, it's a good point. Need to be made.
Right. So top 10 reasons. I'll briefly go over them again. Lifespans are increasing. That means you're going to need more money than you used to be. Historically low interest rates, which also means you're going to need more money than you used to. Most individuals misinformed by the amount of money they'll need for retirement, which falls into those other two. Most people don't understand how much risk they're taking. They're also misinformed on how much fees they're paying and the impact of those fees on their retirement well-being. Most people don't have a good understanding of the accumulation phase of their financial life and the distribution phase. And if you don't have a handle on that, that can be detrimental. With even one of these crooks getting hold of you, you could be detrimental to your own financial well-being. Most people haven't accurately accounted for the ramifications if one of the spouses passes away. They might consider one, but there's ramifications if either spouse passes away.
Well, and if the finance person's spouse passes away, again, just to reiterate, be careful. That's when they really come in because you're suspect.
That's right. Most people don't understand how much they'll need for medical expenses, long-term care expenses. That has to be addressed too. Most people don't effectively analyze their pre-retirement assets to ensure that they're ready for retirement. They'll do simple math calculations, not take into account inflation or any kind of possibility or potential happening down the line. And that just doesn't work. All right, number 10.
Drum roll, please. Home stretch.
Most people don't take the necessary steps during pre-retirement to maximize retirement income and assure they won't run out of money. This is a key point to everyone needing a retirement plan, because some people don't realize once you get to a certain point, let's say I'm 60 years old, I'm going to retire at 65, okay? I've saved an amount of money that will ensure I will never go broke, I will have a great living, and I'm covered inflation and everything else. Or you can just keep 100% in the stock market, and if it keeps going up, you'll be fantastic and great for the rest. But if it goes down in this last 5 years, you could go broke or have to work 10, 15 years more because of one bear market in there. And you have to ask yourself, and that's why you want to illustrate the two possibilities. And once you see that, sometimes you'll say, wait a minute, I've already won the race. I can guarantee the retirement that I want to in 5 years, no matter what happens to the stock market. If I don't save another dollar, if the interest rates go up, if nothing happens to the economy, or if it collapses, I'm still fine. So that is something you need to consider. And these retirement plans will show you that. Our number is 972-715-2424. Remember, there's no obligation. There's no cost. Call us at 972-715-2424, and we'd be more than happy to set up a plan for you.
And I'd add, we talked about it a little bit last week and maybe the week before. If that's too involved for you at this point, at least take the first step. Maybe we can get you a quote. Tell us your age, how long you're going to work before you retire, how much is in the retirement account, and we can give you a quote. Say, this is how much you'll be making year in, year out if you wait this many years with this amount of money, and it'll get you closer to where you need to be.
972-715-2424. All right, guy. It's ready for that time. Let's go over some questions.
All right. No, this is a fairly long one. All right. I'm within 5 years of retirement, and I like your show. Oh, it's starting out good.
Oh, that's right. Is this your mother?
Yeah, it's probably my mom. Hi, Mom. No. I've been listening for years, and your show is the only one that I actually learn something from every week. Besides me liking your show, why would I choose you to manage my money?
That definitely is a plan. That's got to be your mother.
It's Mom. Hi, Mom.
No, one of the reasons we're independent, we don't have any proprietary products here. All right. We are legal fiduciaries, which means we have to put your interest ahead of ours. I'll emphasize why being independent is so important. If I work for a big firm, I'm paid more typically, in some instances, to sell the proprietary branded type of products. Also, I'm going to be more limited on the amount. There have been lawsuits and all kinds of things that have come out that brokers were fired for not selling enough of the proprietary products. Even if a proprietary product might be okay, you don't want to be forced into it because remember, everybody that does one thing tells you every situation deserves this one thing. If I run one managed program, I say, okay, you're 50, you deserve the managed program. You're 78, the managed program. You need income, you're worried about longevity or risk, the managed program. And that is ridiculous.
I would add we are second to none when it comes to customer service. Victor and I both, Victor doesn't talk about it enough, but Victor and I both have been listed in D Magazine for being tops in customer service.
There's a lot of different reasons. There's a lot. The main thing you want to make sure is you've got someone with all the credentials. If they just sell annuities, if they just sell life insurance, they're going to tell you the stock market's a Wall Street casino. If they just do stocks or managed programs, they're going to tell you annuities are the worst. That's the devil's work. You need an advisor that does everything, is compensated on everything. That is the only way possible you're going to get unbiased advice. We got a break coming up, folks. Don't hesitate to call us if you need anything, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. All right, Guy. Today we're answering your financial questions. The first part of the show, we're talking about the top 10 reasons why everyone over 50 needs a retirement plan. A written retirement plan is not some Monte Carlo crap. It's actually a written retirement plan that takes into account your Social Security, your pensions, cost of living adjustments, inflation, and everything in between. If you're under 50 and you're contemplating early retirement, you also need one. Don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. We'd be more happy to set you up.
Yeah, and Victor says Monte Carlo crap. It's just different than our philosophy. What the Monte Carlo simulation does is it tells you your probabilities, what's the most probable rate of return for you and your age. What we like to do through the stress test is plan for the worst, guarantee that the income is taken care of. Then you don't have to worry about probabilities. You have an absolute. We love absolutes.
Remember, if you have a retirement plan that says if the market never goes up, if interest rates never go up, you're guaranteed to retirement. That's a decent plan. You got to make your worst case okay. And if your worst case is fine, you're going to love the average or best case. And that's what the Monte Carlo simulations do, is basically showing you an average case. But, the market could do something completely different 10 years into my retirement, and my Monte Carlo simulation is out the window. But if I always relied on my worst case, I'm fine no matter what.
If we can help our clients avoid the irreversible mistakes, the ones that you can't turn around, and we can give our clients absolutes and then model things around that, we're very happy.
We railed against the life settlements. Now we're doing the private REITs, all of that stuff. We said that can wreck your retirement. You're putting big percentages in those things, so you're listening to some salesman says you should put all your money in there. It's crazy.
Home trading, power trading, all that stuff.
Says, you got to make 10% a month. Retire with $100,000 if you're 17 years old. Are you kidding me? Or the other one, cash out all your retirement accounts. You got a paid for house? What are you doing that for? Get a mortgage, buy my money. This is ridiculous advice, and people listen to it, and it just makes me angry. But
speaking of that, are you ready for some portfolio questions? We got a couple back-to-back here.
All right, go ahead.
First one is diversifying your investments as important as it used to be? Good question.
I'd say it's more important now, or just as important at the very least. You can't have all your money in one type of stock. Like what happened is, right now, it was tech stocks in the 90s, right?
Absolutely.
We know what happened there. Then it was kind of medical type stocks, right? A little after that, we know what happened there. Then it was oil company stocks. People were buying dividends from oil paying, huge dividends,
nice
7,
dividends.
10, 12%.
That's right. ConocoPhillips, big numbers.
Until that dropped. And now what is it? Real estate.
Yeah.
Real estate's the only thing you should be in until that drops again. Trust me, it will. The human beings are always going to be human beings. If there's a shortage on something, we're going to overbuild it.
And
we're going to fill that need.
And we've talked about this before, but think about what rebalancing is. The stock that's doing real well that you don't want to sell is now a large part of your portfolio because it's doing real well.
Right.
So what do? You got to sell the one that's doing really well
and put it in the one that's not.
I know, it's just counterintuitive.
It is very difficult to do, but if you look at just logically, it really is the smartest thing to do. People didn't start with 90% tech stocks in 1999.
That's right.
Or 1990,
Absolutely.
I mean. They actually got that way because that asset class was outperforming all the rest of them. You could have started with 10% and end up with 90.
How many people do you know quit their jobs
or
at least talked about it because they were doing so well trading their own stocks?
Oh, you could have thrown a dart at the Wall Street Journal in the 90s and won 90% of the time.
Oh, yeah.
Yet, everybody and their mother wanted to do this business, and they're going to do it. Remember they had these trading shops where there's like 100 guys, and they pay them to work there to trade their own money.
Try to talk to somebody about something fixed and guaranteed.
Oh, yeah. They're like, oh, get out of here.
Yeah, why?
What kind of loser are you? You know I made 80% last year and standing on my head? Well, go ahead. All right, what's the next question?
All right, well, this is kind of the same question, but it's worded different. I'll go through it. How important is it to rebalance your portfolio? The last question is diversifying your investments.
We kind of mixed them together.
It's kind of the same question, but it's reworded.
Diversifying, obviously, you don't want everything in one asset class. And rebalancing, if you become an allocation, whether it's so much value, your growth stocks, large cap, small cap, international, then you have to rebalance between them because you don't want to be overwhelmed by a particular asset class later. Because usually the hottest asset class will be the worst asset class. They used to have this saying, and it was 20 years ago. They said if you own the top 10% of mutual funds within 5 years, and you will own the bottom 10% of mutual funds.
It's like Money Magazine.
It's a hot thing.
They'll advertise, the top 10 mutual funds. Right. Well, they're not going to be the top 10 5 years from now. Right. Almost guaranteed.
Because like I said, a lot of it's a trending thing. When oil was going up real high, those were the top 10, right?
Right.
Now they're the worst ones. Right now, anything real estate related is doing pretty well. But that's going to turn too, just like it always does.
I got another portfolio question. We got time?
Yeah, we got time for one.
All right. Am I protected from a bear market if I'm in a balanced fund?
No.
Good question, though.
Yeah, I think we answered this a little bit earlier in the show, but it used to be when you have a 50-50 portfolio, half of it was hedging the other half. In other words, I've got no risk on this side, and my risk is on my stock side. And that does work to some degree in a normal market condition. But right now, we've got a 7-year topping market and interest rates at virtually zero. And so as interest rates go up, bonds go down. So my hedging to my stocks has a big possibility of going down. And my stocks after 7 years up also have a big possibility to go down. So what we're looking at is a double anchor. Instead of a hedge, we got two of them that could potentially go down. Something better to hedge that portfolio would be something that doesn't have interest rate risk, which would be your CDs, money markets,
absolutely,
fixed annuities, stuff like that. I want to thank everybody for listening to the show today. Remember, if you have any financial questions or you'd like to take advantage of our no-cost, no-obligation written retirement plan, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice